Good morning, everybody. David Trahair is here, and he is the author of Smoke and Mirrors, Financial Myths That Will Ruin Your Retirement Dreams. Good morning.
Morning, Liza.
So the first thing that we were chatting about when we saw your book was the fact that as soon as anyone hears or sees finance and financial advice, they get all clenched about it and think it's going to be dense material that they're not going to understand. But this is not that.
That's correct. This book is written for, I call it the average Canadian, somebody that isn't an accountant, is not perhaps great at finance. It's written in layperson's terms so that pretty well anybody can understand it. And I think that the myths feed into this idea that personal finance has to be this very complicated procedure and you're never going to be able to figure it out.
So yeah, you need someone to tell you and you still might not get it and all that sort of thing.
Leave it to the professionals, you know, just don't worry about it, it'll be okay in the end. And that is the wrong message.
Okay, so you have a series of 5 myths here that can ruin your retirement savings. So let's go through them. Myth number 1, if I had $1 million, I could retire.
Right. This is based on this rule of thumb that you and your viewers may have heard, that you'll need approximately 70% of your pre-retirement earnings after you retire to maintain your standard of living. I've even heard some of them go as far as you're going to need 100% of what you make now after you retire. And my point is that if you get your finances under control, which is the whole key to this book, I'm trying to encourage people to take control of their finances.
Meaning get out of debt and that sort of thing when you say take control of your finances.
That's right.
Credit cards, mortgages, that sort of thing.
Yes, well that's part of it. Just education, think about your decisions. And if you do that, then, because I've worked through the numbers, that's how I came up with the answers to the myths, is by doing my own personal financial tracking. It's basically taking very boring accounting concepts, principles, and techniques related to running a successful business and applied them to personal finance.
So how much will you need when you retire?
It's a totally individual question. I go through a sample family in here, and I show that they could get by fine on less than 40% of what they're currently earning. Because if you look at it, I mean, and again, everybody's different. But you look at people that are paying the mortgage, they've got children, they got to pay for education, food, clothing, vacations. You know, they're at the peak earning years, so their taxes are high, they're paying into the CPP, the EI. Take all that out, because that's going to be gone after you retire. And you look at it, and it's, in many cases, astoundingly less than they tell you you'll need.
Okay, let's go to the next one. RRSPs are the holy grail of retirement.
I had to get a plug-in for my favorite Monty Python movie, but basically, if you start talking about retirement to a financial planner or some financial planners, in many cases they zero in on RSPs.
Yeah, gotta have them.
That's what we hear,
have them.
especially this time of year. Put money in, no matter how much, try and maximize it if you can. They're all focused on RSPs.
Is there something else you should be doing?
Yes, RSPs are one component of your retirement plan. What's important when you retire is your personal net worth statement or your personal balance sheet or your personal scorecard. It lists everything you own, like your house, cars, your RSPs would be a line on that. But then below that is your liabilities, your debts, how much you owe. And really, the measure of how well off you are is the difference between those two numbers.
So essentially you want to pay off your debt. That could be more important than putting into your RSP at times of your life.
Exactly.
Okay.
My point is that if you retire without any debt whatsoever, your outflows, the amount of money you're going to need to pay all your expenses, is going to be much lower than if you still had your mortgage.
Right.
I mean, if people can go home and do this today, add up the debt payments they have every month, mortgage, car loan, whatever else, credit cards, and see what that figure is. For many people, it's thousands of dollars a month. If you don't have those outflows after you retire, you'll need much less in your RSP.
We're running out of time, so we'll try to get through the rest quickly. Don't worry about your investments. You'll be fine in the long run.
Yeah, well, this is the myth that, you know, put your money in the stock market, and over the long term, you'll get like 8% a year.
Right, don't worry if it goes up and down.
That's right, but the problem with that is that who has 50 years to go between now and retirement, right? So our horizon to retirement is shorter. And the problem with that is that it opens you up to the risk that maybe the stock market's going to be doing this during the next 5 years or 10 years. You don't know where it's going.
Right.
So I'm telling people to take control of their finances. One of the things in the book, there's a CD-ROM in there, and I wrote a little Excel spreadsheet where they can, for instance, calculate their own personal rate of return. like how well their own investments are doing, because most people don't know. So if you still are in debt, fall for the RSP myth, put all your money in an RSP, and then you had lousy returns
and
throughout
you're
your
still
whole
paying
life.
a big rate of interest on the rest of your debt, then you're way behind the game instead of ahead.
Exactly.
Okay. The next word, we have met the enemy and secure your financial future by life insurance. So we just have about 30 seconds. Can you quickly tell us?
Yeah. Well, taxes, nobody likes to pay taxes.
Yeah.
And you have the right to reduce your taxes by whatever legitimate means are available. The problem is that people's hatred for taxes lead them to do bizarre things that are not in their best interest. For instance, tax shelters.
Right.
You know, I'm
Don't
not
do
a
those.
fan of those because you're risking all your money. You may get a tax deduction, but you don't get anything back on your investment.
Right. If it's a little tricky, it could be, or if it's a little sketchy, is what you're saying?
That's right. Well,
Yeah,
it's usually risky.
Yeah.
And it may even be worse than that. It may be a total scam, and you get nothing back, and then the government disallows your deduction, so
Yeah.
you've lost all your money. And
One of those things where if
Ugly.
it seems too good to be true, it probably is.
You got
Yeah,
it.
there you go. David Trahair, he's a chartered accountant, and his book is Smoke and Mirrors, Financial Myths That Will Ruin Your Retirement Dreams. Thanks for the good advice.
thanks, Liza.
Here's Kevin.